And that's why Activity TV is the place to be.
Welcome back. Shares of Whole Foods are with the story. Bob?
Maria, simply put, it's not the company that it was a year ago. The traders complain that the company has a lot of holes in Whole Food these days. For one thing, you're now looking at some...
The Bell, stay with us. My first on Cnbc interview, one-on-one with Treasury Secretary Hank Paulson coming up. Hear what he has to say about the U.S. losing business to international markets and about direct investment coming into this country. That's coming up, top of the hour.
I'll be looking at the collapse on itself.
Hey, welcome back. Talking to Bob Pisani. What do you know? Bring you into the conversation. Since we are doing it to serve you anyway. My goodness. Fed Day, another record.
Yeah.
I mean, honestly, I feel it's beginning to feel like it doesn't matter what anybody does; they're just going to buy the stock market. You can talk about inflation, you can talk about growth, you can talk about whatever you want.
Yeah, you know,
bid the market.
It's not good to second guess the Fed, but the fact is, this time they did the right thing. Remember the food fight when we had the last meeting when they changed everything around and everybody had a big argument about what exactly are they talking about? Today, they did nothing. They made a half-sentence change right at the top and left everything the same, and that's perfect. Why is it perfect? Because now the bulls can say, folks, if it isn't Goldilocks, it's close enough. Slow growth, modest inflation.
Bell rings and other records in the books. Maria Bartiromo with Hank Paulson in Washington, D.C. on the closing bell right now.
Hi, everybody. Stocks powering ahead in the final hour of trading today on Wall Street, closing out the session at, yes, another all-time record high for the Dow Industrials after some wild swings following the Federal Reserve's decision on interest rates this afternoon. Hi from Washington today, where the FOMC decided to keep interest rates unchanged at 5.25% today. That was one of the big stories, but probably an even bigger story is the wild swings for stocks on Wall Street. Stocks rebounded late in the session today after a somewhat sleepy reaction to the Fed inaction. And then in the final stretch of trading, with an hour to go, the blue chips once again powering forward, finishing in uncharted territory. The momentum is strong. As I mentioned, the Federal Reserve stayed pat today on interest rates. That was widely expected. Rates remaining at 5.25%, where they have been since last August. The Fed noting that while economic growth is slowing, it still sees inflation as a risk. In the Fed statement, the committee said the predominant policy concern remains the risk that inflation will fail to moderate as expected. Future policy adjustments will depend on the evolution of the outlook for both inflation and economic growth, as implied by incoming information. That basically tells you it's all about the data. The Dow reacted wildly right after the decision, but powered higher late in the session. Take a look at what happened about 2:15. As soon as we get the inaction, the Dow Industrials goes negative, only to come back, bounce, and then with about an hour left, we saw new money coming into this market, and the industrial average rallies 54 points, about 0.5% at 13,363. Both the S&P 500 and the NASDAQ tonight are at 6.5-year highs. The Standard & Poor's 500 index at a level of 1512.5, up 5 points. Again, that is highest level in about 6.5 months. Ditto for the NASDAQ. It is also at the best level it has seen in 6.5 years, with a gain on the session of 4.5 points. And again, a similar chart pattern there. Negative right after the decision to leave rates where they are, coming back only to power forward in the final hour. Also giving equities a bit of a boost today, a drop-off in the price of oil. Crude oil today finishing down more than 1% at now a level of $61.55 a barrel. Let's get the full market breakdown now. Bob Pisani, our eye on the floor of the New York Stock Exchange. Rick Santelli's in Chicago at the Mercantile Exchange with the reaction from bonds. Bob, kick us off.
Thank you, Maria. Not just the Dow and the S&P, folks. Russell 2000 small cap index, historic high. Mid cap index, big important index now. A lot of money in that historic high as well. Let's take a look at the markets today here. Very simple from the way the traders looked at it. Happy to leave everything alone. Basically, the Fed said to traders the economy is slowing, but it's still growing. Inflation comments unchanged. That's great. Bulls down here said, listen, if it's not a Goldilocks economy, it's close enough. Everybody's happy. among the bulls. Take a look. Feverish M&A speculation. Folks, I've spent most of this week tracking down M&A rumors that have been going on. That's what's been powering the market. And if you're not in M&A, then buy back stocks. CBS did that today. Their stock was at a new high. The next milestone is the S&P 500 historic high. Look at the S&P for the last few months. 1527 would be the old historic high. That's what would be blowing away the last remnants of the dot-com bust that we saw so many years ago here. And what's been helping the S&P 500 recently? Take a look. Maria, tech stocks, believe it or not, a whole group of tech stocks are hitting new highs today, including Intel, IBM, that's a 5-year high, Hewlett's at a 6-year high, Texans at a 6-year high, and Apple is at a historic high. When was the last time you see all those stocks hitting new highs together, Maria? It's been a while.
All right, thanks so much, Bob. Let's get to Rick Santelli with reaction in the bond pits today. Rick?
Well, you know, Maria, there is a lot of action. Now, it might not compare to equities, but intraday 2-year note, these yields really moved up higher. Remember, short maturities are the ones you want to watch when the Fed's digging in the way they are on inflation. That yield moved up from a 466 up to a 473, a big jump. These are going to be the highest yield closes since about the second week of April. Now, a 10-year note yield, the next chart, granted it moved up, but only 3 basis points, so there's more inversions, 473 twos, 466 10s. As for the money trade today, it was the equities. Now, if you look at the intraday S&P, you could see that EKG-like look right around 215 to 245 Eastern, the effects of the Fed. But as the dust settles, this market's solid, and there's still a lot of buying coming in, which means tomorrow morning, you have to check out what the European Central Bank and the UK Central Bank do, because the dollar was bid, but not as much as people would have thought. Maria, back to you.
Rick, thanks so much. It's a good point, but we're watching the global central banks for sure. Investors had one eye on today's Federal Reserve meeting and another on Wall Street, where stocks claimed record territory once again. But as the market is scaling new heights, is there still room to the upside, or should investors be taking some profits? Joining me now with a look at today's Federal Reserve decision and how to ride this rally, Wayne Angel, principal at Angel Economics and a former Federal Reserve governor, along with Michael Vogelsang, president and chief investment officer at Boston Advisors. Gentlemen, nice to have you with us. Welcome to the program.
My pleasure.
Wayne, nice to see you. Thanks for coming into the studio. Let me begin with you. Give me your characterization of the Fed meeting. And you were not expecting any move by the Fed, correct?
No, there was no indication they were going to move.
What'd you think of the statement?
The statement lacks a lot in desirability. The statement looks back at what was the case, and the Fed was too easy 2 years ago, and the Fed was too easy in 2005, and so consequently we have a higher rate of inflation now. But that inflation we have now has nothing to do with the current level of policy.
Do you think that they have to keep reiterating inflation, that they're watching inflation? I mean, why talk about inflation if it is not an issue? I mean, you're saying this leaves a lot to be desired. Then why would they put this statement out?
Well, Marie, they and others seem to think it's an issue because there are those people that think that the unemployment rate determines the rate of wage increase. Mm-hmm. That's never been the case, but even so, it does not result in an inflation spiral. We had inflation from the labor side when we had labor union monopoly power that existed under the Wagner Act. But my goodness, we're years and years away from that.
Well, I want to get your thoughts on what Rick Santelli just said in Chicago, and that was that we've got to be watching the global central banks to see if they're going to start moving, and also. You say no inflation. Wages are up, oil's up. We'll come back to that. Michael, let me ask you the obvious question here. How do you invest in an environment that we're in right now where we are seeing record highs on the market, and yet the Federal Reserve is just standing pat talking about inflation but not doing anything?
Well, the highs don't surprise us all that much. I mean, this market clearly has, as you pointed out, tons of momentum. We have the sort of M&A private equity put. If market falls, the guys are going to come in and start buying stock again from you. So I think investors feel very comfortable with that. I think it's a worry, frankly. We're getting a little bit overheated, to say the least, and it wouldn't shock me to get a significant pullback here. But the underpinnings of this market are very strong. I think this whole thing is predicated on the long-term interest rate levels around the globe. I mean, the fact of the matter is if we'd get the 10-year and those around the globe up 100 and 150 basis points from here, this stock market wouldn't stand a chance. So I think this is an interest rate driven market, mostly because of the buybacks and the private equity. And the fact is it's cheap to fund it.
So it's a liquidity story and it's an accommodative credit market story. You think we're going to see a further upside? You think that we're going to see a good 07?
Yeah, I think 07 is going to finish up fine. I mean, I think we're doing pretty well. If we're not in double digits yet, we've got to be pretty close. I mean, I don't think there's anything standing in the way here other than other than people's own worry. The fact of the matter is it's demand driven, right? So the last thing that you want to happen if you're a portfolio manager is to be out of stocks when a stock you sold yesterday gets taken out at a 30% premium. We can speak from firsthand experience on that. So I think people are scared to get out of this market. And when that happens and there's a strong demand coming in from outside, from either corporate buybacks or M&A and private equity,